Our classroom stock portfolio has an annual return of 19.01%, and the portfolio is now worth $2,084.83 after 128 weeks. Almost 2.5 years ago, we started investing $12.50 per week, and we then take that money and split it up to buy 10 different dividend-paying stocks. So that's about $1.25 per stock. And look how much those small investments have grown to. Hi, Professor Rex here. This week I added a slide explaining how my original investment in Broadcom 4 years ago is now providing an 8% yield based on my original investment, and how Home Depot is providing a 31% yield on investment made in 2003. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting a little over 2 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month. And we invest into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week, or see the list of our best performers, or any other section of the video. In 2022, the year we started the portfolio, the market didn't perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then, in 2023, stocks took off. Currently, the portfolio's value is over $2,084. The portfolio's return has been 19.01% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500. And in the preceding year, our first year, the portfolio once again beat the market. So why do we only invest in dividend-paying stocks in this portfolio? That's explained on the next slide. The first reason we stick with dividend-paying stocks is, according to a Harvard study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year. So go check out the source link that I included at the bottom of the screen. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. Now, the holy grail of dividend investing is having a stock portfolio that produces a growing stream of income that provides, one, a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And two, a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payment to bondholders. Now, here are two examples of stocks growing their dividend payouts over the years. The first is Broadcom, a chip maker. In 2020, just 4 years ago, for my taxable account, I bought Broadcom. At the time, its yield was 5.01%, meaning for every $100 I had invested in the stock, I would receive $5.01. The company has quickly grown the dividend to the point where the yield based on the original investment is now 8.13%, and that's just 4 years later. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. And that's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a very diversified portfolio. This is the power of investing in a quality dividend growth company. My second example of a high quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I invested in the stock, I would receive only 83 cents. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield based on the original investment is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly will not find a bond that pays anywhere close to the yields on cost that these two stocks are paying. And bonds do not increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you are married and filing separately. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees. And if you're single, that amount is $61,625. Those amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. Now, how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then add that to the standard deduction, which is found in IRS Publication 505. As you can see in 2024, the standard deviation increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly, and I accidentally said separately earlier, could generate in income from qualified dividends that would be federally tax-free. So why did we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? Let's talk about that on the next slide. The main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you do not need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck, but found the process to be so fun with my class that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. Now for our classroom stock portfolio, in year 2, we boosted the weekly investment by 82 cents for a total of $13.32 per week. That's because inflation was higher that year. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker SCHD. And as you can see, I've got a graph over on the other side. So let me fix that real quick. Now, SCHD is a large holding in my personal accounts, so I've been tracking SCHD's performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio's value is over $2,084. If we had instead invested the same exact amounts into SCHD on the same days, the portfolio's value would be only $1,777, a difference of 17.3%. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has, at times, had large positions in stocks I consider to be value traps, and sometimes it's low on tech stocks. Now this slide shows our best performing stocks based on when they were initially purchased. One of our stocks has tripled and 5 have doubled. And remember, this is only in 2.5 years. Broadcom is at the top with a total return of 210% in about 2 years. Broadcom is a chip maker, and this week it announced that it would split its stock 10 for 1. And as you'll see on a slide in a bit, the stock went crazy this week. And remember that our total return includes both the dividends the company has paid as well as the increase in the stock price. Now let's turn our attention to the strategy column, specifically the category called dividend growth stocks. 90% or more of our investments made in this portfolio were made in these stocks, which means they are high quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% of investments so far have been made in smaller, under the radar companies that have recently started paying a dividend. Usually they're smaller, but not always. These under-the-radar dividend-paying stocks tend to be riskier because they tend to be smaller, but studies have shown they historically beat the market averages by a significant amount. This slide shows our best performing stocks this week. Our best performing stock this week was Broadcom with a 23.3% gain, followed by Skyworks with a 14.9% gain, and then NVIDIA with a 9.1% gain. The others were Apple, Applied Materials, KLA Tencor, Carrot Packaging, Lam Research, and Microsoft. Good old Microsoft. Before we look at the 10 stocks we bought this week, here are the 10 stocks we bought a year ago, along with their total returns, which of course includes dividends. Domino's Pizza is the best performer of the stocks that we bought that week, so far providing a total return of 74.6%. We still own all the stocks except the stocks in yellow. Most of these stocks were purchased over multiple weeks, which is why many have appeared in recent videos, but this slide only refers to the investment made a year ago. We sold Fidelity National Info Services because they cut their dividend. This particular purchase of Fidelity provided a 29% return in less than a year, despite the dividend cut. We sold Agilent and Robert Half because they appeared to be fairly valued. The average return of the 10 stocks we bought a year ago is 31.2%, despite 3 stocks not being held the full year. The annualized return for all 10 stocks is 33.9%. Obviously, our purchases won't continue that high rate of a return, but it's a great start so far. Now let's look at the stocks we sold this week. We don't often sell stocks, but this week we did sell one because it appears to be fairly valued now. The stock is Best Buy. Its total return based on the initial investment was 40% in a little bit less than 7 months, an annualized return of 79.5%. Best Buy was part of our dividend growth portfolio and our high yield portfolio, which I'll discuss later. Now let's talk about the dividend growth stocks we bought this week. Here are the ratings for the top 14 dividend paying stocks this past week. They are Comcast, MasterCard, Visa, American Express, Masco, Allegiant, Northrop Grumman, FactSet, Microsoft, Chevron, Interpublic, Cigna, Nike, and Huntington Ingalls. We purchased the 10 stocks that are not in the yellow highlight. The stocks in yellow have already grown to be 4% or more of the portfolio, so we did not invest more in them this week because we want to build a more diversified, less risky portfolio. Remember, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it up amongst the 10 stocks that we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks we are purchasing that week. Now, for the sake of convenience, there is nothing wrong with simply turning on the broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide includes a company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks this week appear to be Comcast, Allegiant, Northrop Grumman, Masco, and Chevron. Remember, all these stocks pay a dividend and have recently increased their dividends, and their methodology used here indicates they're likely to continue to raise their dividends. Therefore, this is a dividend growth strategy. The stocks with the highest yields this week are, in order, Interpublic, Chevron, and Comcast. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks that we rate as a B- or better. And now, well, that's for about 90% of our purchases. The other 10%, as I mentioned before, are invested in those usually smaller, under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying companies tend to be riskier because they usually are smaller, but studies have shown they historically beat the market averages by a significant amount. But all the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of the reported earnings, also called profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at American Express, FactSet, Microsoft, Nike, and Huntington Ingalls. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. And the companies earning the highest financial health ratings this week are MasterCard, Visa, and Microsoft. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that pay both a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Comcast, Visa, Allegiant, Northrop Grumman, Chevron, Interpublic, and Nike. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade, dividend growth potential, the companies in the best position to increase their dividends substantially are Comcast, MasterCard, Visa, and Microsoft. The companies with the best combination of recent dividend increases and potential of future dividend increases are Comcast, MasterCard, Visa, and American Express. On this slide, we're looking at the stocks in our portfolio that have raised their dividends recently. As I mentioned before, the holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by about 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. This week, Taiwan Semiconductor, ticker TSM, raised its dividend. Now, the chip maker has a variable dividend, but it's good to note that its dividend increased 11.9%. It's the second consecutive quarter for the company with a higher dividend. Since September, it raised its dividend by 23.5%. Now, the last 17 dividend increases for the portfolio have an average of 16.8% increase in the dividend. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of our every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and the dividends per share that we received once the stock split has occurred. Now this week, Broadcom announced it will split its stock 10-for-1 effective July 12th. Also of note, Williams-Sonoma, which we recently sold and made a nice gain, announced it will split its stock 2-for-1 and also announced an increase in their dividend. We may have sold Williams-Sonoma a little bit too soon. And it's a high quality company, so there's nothing wrong with buying and holding the high quality companies forever. And here's a look at the 10 stocks that make up the largest portion of the portfolio as of Sunday. Microsoft is still on top as tech had a good week. MasterCard made the biggest move from 6th place to 4th place. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. Now, it's true that our portfolio's return would likely be higher if we always invested in just our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated and more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are now at 94. That might seem like a large number of companies to keep track of, but the spreadsheet that we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take that much time. Now, I've had several older students who are closer to retirement that are in my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of last year, we started investing $12.50 each week into stocks with higher dividend payouts. Currently, the portfolio's dividend yield is 4.56%, but the companies in it likely will not grow as much as the dividends in our as much as the stocks in our dividend growth portfolio. Therefore, this portfolio would be more geared towards investors closer to retirement. The portfolio as a whole has an annualized return of 22.07%. Now, since the portfolio has been in existence for less than a year, that return will likely fluctuate a lot. Now, two strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth, and so far has been the better performer. The average return in this strategy has been 10.96% and has been held for an average of 146 days so far, which is an annualized return of 29.6% using Excel's rate function. Now, there's no way we can keep up that annualized return that quite that high, because stocks historically over the long run average about 9 to 10% per year. On the next slide, we'll look at the high yield dividend paying stocks we bought this week. Now, as I mentioned, one thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. Strategy 1, the first 4 stocks listed, emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close to retirement. Strategy 2 still emphasizes higher dividend yields, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Now, because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means that a stock could appear in both strategy 1 and strategy 2. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8, which is equivalent to 1/4, which of course is 25% of that week's investment. Now, both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high yield stocks we bought this week while implementing strategy 1 are Devon Energy, Chevron, Interpublic, and Gilead. And the 4 high yield stocks we bought this week while implementing strategy 2 are Chevron, Interpublic, Papa John's, and Evergy, the electric utility. This week's purchases have an average yield of 4.5%, with Devon Energy coming in at the highest with a 5.9% dividend yield. And on this slide, here's a look at our ratings for competitive advantages, management, and financial health, the same layout that we use for our dividend growth portfolio in previous slides. And on this slide, we can see their grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consist of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. Kind of like Home Depot back in 2003 when it was only had a yield of 0.83%, but has increased its dividends substantially now. So that's it for this week. In the comments, let me know if you have any questions. Also, let me know what other kind of investing videos you might like to see. And finally, here are the places you can reach me. YouTube, obviously, as well as X and LinkedIn and my website, beatthestockmarket.com. We'll talk to you next week.